Pankaj Murarka is also joining us from Renaissance. Pankaj, how was your day? Your portfolio has all come back to all-time highs. Getting calls from clients, or not quite?
Absolutely, Ajay. Can't be better. Can't ask for more. That Indian economy is doing very well. We've had the fourth quarter GDP numbers, which has been a big surprise, and now we have history in the making where you get third successive clean government with a full majority and probably accelerated reforms. So I think can't ask for more. It's surely a sign of things that all of us should expect to come in days and years to come for all of us in India.
Put your incremental capital, because a lot of I've been speaking with a lot of friends like you who manage money professionally, and they had a section of the investors who said, no, I have to invest incremental money, but let this event be out of the way. Now that money starts coming back, would you find it a little, kind of challenging to deploy that, because valuation has completely, got risen across the market right now?
Not really, Ajay. Meaning, I have a slightly different take here. I think the good thing is the election outcome is what was expected, so there are no negative surprises here. And while all of this was to a significant extent baked in into the markets because the markets were expecting the outcome, what it really does is it ensures continuity of policy reforms and a stable government over the next 5 years. So what we should really look forward to is probably very accelerated reforms because the same government comes back and for a third term, which we haven't seen in India for a very long time, which effectively means the government will start hitting the road on day one itself. All of us know that the government already has a 100 days agenda of accelerated reforms in place, so we probably should start seeing policy actions on that count. So all I'm saying is, for someone looking from a slightly more medium-term perspective, valuations don't look that expensive in that context. Probably their markets at this point of time are fairly priced, but in the context of the growth and stability that India offers over the next 5 years, I still think this is not a bad time to invest. So, and we have enough ideas to invest. So I don't find myself as an investor being short of investment ideas.
An insight into what those investable universe or those ideas are right now? Is it more of those manufacturing, defense, capital good, industrial themes? Or is it now getting a lot more broad based into, let's say, rural recovery, the underperforming sectors like financials, FMCG, IT also?
So, well, as you rightly said, Anisha, it's very apparent over the last few years, and I think that trend will continue, that India's growth over this decade will be driven by investment cycle, and which is where we've seen central government capex has already gone 3x in the last 4 years from where we were pre-COVID to where we are currently already at about 12 lakh crores, and probably government there are already noises about government increasing the allocation to investment allocation in their budget expenditures. So clearly, all those sectors that you talked about relating to manufacturing being driven by China Plus One or industrials, defense, and will continue to drive or lead growth in the economy. And as a result, those sectors will deliver, or companies in those sectors will deliver much higher earnings growth than the aggregate earnings growth. Having said that, we have the opinion that probably we're seeing early signs of recovery in rural India as well. We've had a cyclical slowdown in consumption over the last 12 months, but I think probably we should have a good monsoon this year, and probably post that during the festival season, we should see a cyclical rebound in consumption as well. When it comes to portfolio, so obviously we continue to remain overweight on industrials, defense, and manufacturing. But at the same time, my view is that some of these underperforming sectors like IT will come back because we continue to remain very positive on global economy and global IT spend. So we also think that IT will come back, and financials ones, which has been a laggard, should also start performing from second half of this year.
Talk to you about that point which you just made, the consumer. If indeed, the big commentary coming in from all the four large players in consumer side is any guide, have you started adding some of those names in your portfolios or not yet?
So we are adding consumer discretionary. We think we want to play discretionary spend because we think growth there will be much higher. And we have seen, as I said, because of the slowdown in the consumption of the last 12 months, that sector has been adversely impacted, and stocks actually have are down about 20 to 40% across the sector in the last 1 year. So probably yes, on the consumer discretionary side, we've started nibbling, and probably we intend to probably gradually build our position across consumer discretion. So that's one sector which we segment which we like within the consumption, though we want to avoid consumer staples, because as I said, we can find higher growth, much higher growth in other segments of the economy.
Okay, point taken. But Pankaj, what's the view on the Adani group of stocks? Clearly, they are firing away, have managed to hit the market capitalization that was even higher than that Hindenburg time. What's the way forward for them, and what's the best bet within the pack?
Well, we do not have exposure to the group, I must say. Having said that, when you look across the businesses, they're at the core of the economy across the key sectors of the economy, which are the growth drivers, including ports, infrastructure, energy, power, and so on and so forth. So obviously, across the board, the companies have done exceedingly well. But as investors, we like companies which pursue organic growth, and companies which do not take too much of leverage on their balance sheet while they execute their business. So while we are focused on growth, but we like conservative companies within that. So we do not have exposure to Adani Group.
Pankaj, hi, afternoon. Well, the one pocket which is really flaring up today has been the government-owned oil and gas names, right? I mean, I'm just looking at GAIL, ONGC, OMCs, the entire pack is abuzz. Is that a space that you're looking at?
Absolutely, Aisha. I think one, obviously, there's been a strong earnings tailwind in the sector. More importantly, there's been expectation that probably one of the big reforms that this government can actually execute is bring auto fuels under GST, because that's one big segment of the economy which is clearly out of GST. And if just in case if that happens, I think probably all of these stocks have a significant room to rebound from. The whole sector will see a big valuation re-rating. Aside of that, I think valuations in the sectors are still significantly low, and probably the sector is having a strong earnings tailwind. Different segments of the segments of the sector are doing well. For example, we're in an upcycle in global refining, so refining margins have been pretty healthy. Retail fuel margins for OMCs have been pretty decent. Oil prices have been holding firm, so that's helping the upstream companies. So I think across the board, there is significant value in this sector. And probably, I think just in case if we see reforms on that count, I think that could provide a significant re-rating for the sector as well.
Pankaj, what about stories like Reliance? I mean, it's almost the last one along with HDFC Bank to participate in this rally. But do you see a meaningful move after maybe this week?
Well, Reliance, meaning given the size and scale, obviously it can only move at that pace. But I certainly see, because all the businesses are firing. If you see, retail is doing pretty well. On the telecom side, the expectations are very high. Probably we should have a tariff hike sooner rather than later, because it was supposed to happen last year and it's been postponed for almost pushed back by almost a year. So I think we should see, and rate hikes in telecoms or tariff hikes in telecoms, and Jio should be a big beneficiary of that. Reliance is making significant investments in new energy in their traditional oil and gas business, where they're transitioning the business. So I firmly believe the businesses are really firing. All the businesses are firing, and it should do well, reasonably well. Having said that, in a strong growth cycle like this, there are obviously smaller companies which can grow at a much higher rate because of the smaller base, and given Reliance's large conglomerate nature. But I still think the stock, while it has underperformed Nifty over the last year and a half, I think from here on the stock will at least deliver index performance.
Last question from my side. Pankaj, what's the best space to perhaps book some profit right now? Real estate, autos, what comes to mind if you have to do a bit of a sector churn? Where would you take the money off the table from?
Well, why should one take money off the table? It's time to put money back into the table. Just think about it in the context that this government now is starting its third term, when Indian economy is about $3.6 odd trillion. Now that we have visibility on 5 years of stability and 5 years accelerated growth, the global environment, global macro environment is fairly supportive in that sense, context. Probably by the time this government finishes this term, India should be an economy which will be closer to $7 trillion or $6.5 trillion. in that context, market should do well. Having said that, even one has to do take money off the table. Probably, I would say consumer staples is one where one should go underweight and probably reallocate that money to some of the faster growing sectors or companies within those sectors.
Right, Pankaj, we'll let you go on that one. Thanks so much for joining us on this interesting day.
If you like this video, then like, share and subscribe to ET Now.